So I'm sure you've come across the term premium and discount before, and you're probably wondering, what more is there to learn? Well, here are three things we're going to be taking a look at in this video. Okay, first, we're going to take a look at how to identify premium and discount zones in a leg of price action. Okay, so this is where I take you through how to draw your Fibonacci correctly so that you are easily able to identify these zones within a particular leg of price action. I'll also show you the settings that I use to make it easier to spot these zones very easily. It's a template for your Fibonacci tool. Okay, then we're going to take a look at the logic behind these zones using economic theory. All right, because I believe that if you understand the principle behind the concept, it's easier to believe in that concept as far as your own beliefs and understanding of the market goes. And this will also help in your strategy development phases, especially if you're a new trader. All right, it'll give you more confidence to infuse that into your process. And then finally, we're going to take a look at some real life chart examples. Okay, so first of all, mapping these zones. So here we have our Fibonacci drawn, where we have the 0% level, 50% level, and the 100% level. Now, it's important to note that within a particular leg of price action, like the one we have here, so we had an expansion and a break of structure, a retracement, and then another break of structure. And if we pay attention to the name, it's called the Fibonacci retracement tool. So the premium and discount zones actually come into play when there's already a pullback happening. Okay, in this whole leg of price action with the break of structure and then the pullback, this is what we consider the discount zone. Okay, the zone underneath the 50% level is called the discount zone, and the zone above the 50% level is called the premium zone. We have the same thing when we have a leg of price action to the downside. So we have bearish price action here, where price has broken structure to the downside, retraced into this 50% level, right? And then it's broken structure again. Same thing, above the 50% level, we have the premium zone, and below the 50% level, we have the discount zone. Okay, now, so I'm going to show you how to identify these zones using a modified Fibonacci retracement tool. So let's just click on this. Right, so this is our leg of price action. This is the leg that broke structure, and this is the highest point before our retracement began. So this is how we're going to draw our modified Fibonacci tool. You can see that above the 50% level, we have our premium, and below the 50% level, we have our discount. Okay, when you are in a buy scenario, you want to be taking buys from the discount zone, and it makes perfect sense, right? If you were a buyer in a market, you'd want to buy your item or your product at a discounted rate. The opposite goes for selling, where you'd want to sell your product at a premium rate at the highest possible price that you could possibly think of. So that is essentially how the premium and the discount zones work. So same thing goes for the sell scenario. We have price breaking structure and retracing, and this is the lowest point before the retracement began. Okay, the premium zone is above the 50% level, the discount zone is below the 50% level. Now, when you select your Fibonacci retracement tool, it's not going to come this way. It's not going to look this way right from the start. You actually have to go to your settings and untick every other option except the 0, 1, and 0.5 level. Now I like to give my 0.5 level a different color just to differentiate, just to easily spot the mid level. Okay, yeah, essentially. Now you can decide to have your level show or just use this. This is actually how I prefer to use mine, but for the sake of this tutorial I've added levels which can come in terms of, which can be shown as percentages or as values. Okay, let's delve into some economics. Now, if you did any form of elementary economics at any point in your life, then you're probably familiar with the laws of supply and demand. Okay, so let's take a quick look at the relationship between the law of supply and premium zones. Okay, so according to the law of supply, right, the higher the price of a commodity, the higher the supply is going to be. Because as we looked at not too long ago, sellers want to sell at the highest possible price. This is just human behavior as far as economics go. So assuming we have the price of a commodity at this point, the quantity sellers are willing to sell is going to match up with the price. But as we go higher on the price axis, the quantity that sellers are willing to sell is going to increase. Okay, as we go higher, the quantity is going to keep increasing. Right, so if we look at this in terms of financial instruments or forex pairs, as we start to approach the mid level, okay, now we're beginning to enter the premium zone of this graph, same as the premium zone of our modified Fibonacci tool. Okay, it means that at this price and above this price, sellers are more willing to sell and in higher quantity. Okay, so what this translates to in terms of your trading, your chart, is that within the premium zone, not only are sales more high probability, but you have a higher probability of catching a voluminous move. Okay, you have a higher probability of catching what some people might refer to as an institutional move, because as much as we all have our theories about the market, some former institutional traders and even current ones will tell you that what they do is actually very rudimentary. There isn't a lot of complex stuff going on. They use Fibonacci tools just like everybody else. They deal with ranges, they deal with horizontal price levels where they believe that price might sell or buy from. Okay, so the premium zone and the discount zone is something that we all share in common. It's an idea, it's a psychological concept that we all have in common. It's basic economics. With the law of demand, we have the opposite. The higher the price, the lower the demand, which makes sense because when you go to the market, you're not going to want to buy a product at the highest possible price or at a really high price. Let's just say at a really high price. In a free market, you're going to want to buy at the lowest possible price, correct? Okay, so as the price gets lower, the demand increases. As the price gets lower, the demand increases. And somewhere at this midpoint, we get into the discount zone. Okay, same principle, just the reverse. Now, from this equilibrium price lower, the demand keeps increasing, correct? So what that means in terms of trading is that at the equilibrium price and lower, there's a higher probability for buys to take place, not just by institutions, but by other traders who want to buy at the lowest possible price as far as a leg of price action goes. Okay, and not only that, it also increases the chances that you're going to catch a move with enough liquidity and volatility behind it, or simply put, collectively, with enough volume to it. All right, that's pretty much that for the relationship between discount and demand, as well as premium and supply. So for our first chart example, first of all, let's identify what this leg of price action represents. Okay, here we've had a break of structure to the downside. So the next thing to do is that we're going to have to use our modified Fibonacci tool to determine where the premium zone is. But it's important to do this when the pullback has started. Okay, so the pullback started at this point. Okay, so as a rule, this is how I know that my pullback has started. When the current candle goes above the previous candle. Okay, it's a 3 candle rule. So the first thing is this candle has to have a lower low than the previous candle, and then the next candle has to break the high of this candle without breaking the low. Okay, so it's kind of like, it looks something like this. It's a 3 candle rule. In the same vein, if it's a high, this candle has to have a higher high than the previous candle, and then this candle has to break the low of the previous candle without touching the high. Okay, and that's exactly what we have here. Cool. So we began this retracement, and you can see that as soon as price tapped into the premium zone, we saw this huge rejection here forming a wick, and then price sold all the way to then break structure again to the downside, and we repeat the cycle. Now, we're not going to get into details, but depending on your strategy and how you like to trade, you can actually look for your point of interest within the premium zone. For example, say you're someone that likes to trade fair value gaps. Well, this is a very nice looking fair value gap here. Okay, just an example. Say you're someone who likes to take trades off of breaker blocks. You might say, fine, price has tapped into this breaker block, but I'm going to wait until it gets into the premium zone. Really good strategy. Okay, so let's look at a discount zone scenario. You have price break structure to the upside here, and the retracement started. Remember, the retracement started why? Because this candle here broke the high of this previous candle, and the next candle broke the low without touching the high. So we know it's a new high, right? So as soon as price comes into this discount zone, what do we have? We have this huge rejection here, and then price goes on to break structure to the upside again. Now again, if you're someone who likes to trade fair value gaps, you might have taken the trade from this fair value gap coinciding with the discount zone. If you like to stick to other blocks, you might have taken the trade off of this other block, or whatever you like really. But essentially, this is how premium and discount zones work. If you've watched up to this point, thank you so much for tuning in and for enjoying the video. Hopefully, please leave your like, comment, and subscribe to this channel because there are more videos like this to come. Thank you.